G'day folks, it's Jim here. It's Saturday the 23rd of October. The markets have just finished fairly flat on the day. It was a fairly choppy session on Friday, although not before both the Dow and the S&P had made new all-time highs. But further gains were really capped by Jerome Powell. The Fed chair said that it's time now to begin tapering, although he did reiterate that rates won't be rising at any time soon. So that had the effect of the US dollar moving sideways. There was a fair bit of action in the foreign exchange markets through the yen crosses. We'll go and have a look at those in a moment. The S&P, although it had made a new high, that finished very slightly lower on the day, and the Dow finished just in the green. The NzdJpy finished a little bit lower. That was dragged down. But the tech sector's doing it a bit tough at the moment, led by the shortage of chips. And that is seeing the NzdJpy dragging along behind for the time being. Commodities sector, we saw oil has made another new high since 2014. That finished above $84 for the week. Gold looks like it's about to have another bash at 1800. I think it's going to get through there at some stage. And the precious metals look okay. The base metals, on the other hand, they're a bit concerned, I think, about the Chinese slowdown, and we saw all the base metals finish a pretty tough week, all in the red. But that aside, it was all about the corporate reporting season, and that really gets underway next week. We've got all the heavy FAANG companies reporting next week, so it's going to be a fairly active week. We've also got some central bank activity next week, and we're going to have a look at the calendar at the end of the video. But in the meantime, let's go and have a look at the charts as normal, starting with the dollar index.
Okay, folks, so here we start with a weekly chart of the dollar index. And as you can see from these levels here, we're sitting really right on this pivot. I'm not sure if it's a neckline of signaling further gains or not, but for the time being, it appears to me that we're probably going to continue to chop around these current levels. The daily indicators look very mildly positive, but not really showing us much directional bias. So sitting here at 93.60, it wouldn't surprise me if we see more of the same early in the week or in the week ahead anyway. This level here, the 100-week moving average, that's at 94.20. So that's going to provide resistance, and if we were to break above there, we've got this at 94.80. And I don't think we're likely to get that high. If we come back to the dailies, here you can see what I mean. We're sitting kind of on this pivot, and the daily indicators actually are pointing lower, so we might get a little bit heavy and come down and test these levels. They're a long way away, really, given the current volatility. That's at 92.85 or so. I don't think we're going down there, but I really suspect we're probably likely to push around here. The real interest, I think, is going to continue to be in the stock market as the corporate reporting season progresses. And if we go out and have a look at the monthlies, although the dailies are pointing low, let's just have a quick look at the monthlies. And as you can see, the momentum indicators here are winding up to push higher from a fairly low level. I don't really think there's an awful lot of downside for the dollar itself. And if we do come lower, this the 100-month moving average is sitting just below here till 93.25 or so. So I think that's probably going to be pretty good support. In terms of the euro, we'll go and have a look at that in a minute. But really, for the time being, I think overall we can probably expect more choppy trade ahead, with the exception possibly of the yen crosses. We'll have a look at them in a minute. But the euro, I'm not really all that interested in for the time being. Having said that, we'll go and have a look at the charts now. Okay, here we have a 4-hour chart of the euro. And as you can see, it's been pretty uninspiring this week. So 116.15 or so has been the low. Below 117 has been the high. So it's been a pretty tight trading range for the last few sessions. This white line here, that equates to that neckline. We can see that more easily on the longer term charts in a second. But the indicators are really showing us nothing. And if we move forward to the dailies, they're actually pointing a little bit higher, in line with the dollar index, which is pointing a little bit lower. So showing the possibility of a little bit of euro strength early in the coming days, in the coming sessions. But this level here at 116.80, that might prove problematic. And above there, well, we're probably going to squeeze slowly higher. The 100-day moving average here is at 118. I don't expect to get there. If we look at go further out still, and here we are with the weeklies, as you can see, the 100-week and the 200-week moving averages are doing a pretty good job, really, of acting as a magnet for the time being. This white line, once again, that's the neckline as we saw it on the dollar index. So the weekly indicators fairly neutral, and if we go even further out to the monthlies, here we have the 100-month moving average coming in line with that neckline. So I think if you want to trade the euro at the moment, probably through the crosses, and particularly through the yen cross, is the way to go. So I think really sterling and the Swissy are probably much the same. I'm not really going to go into those. We'll go and have a look at dollar yen though. Okay, now we'll start off with a weekly chart of dollar yen, and it actually made a 4 or 5 year high going back to this point here last week, 114.70 or so. It hasn't been able to hang on to those, and it's actually retraced somewhat, but the weekly's still a point higher. So I haven't lost faith in the fact that we're possibly, as long as the stock markets remain bid, as long as risk sentiment remains positive, I think we'll see dollar yen resume its uptrend eventually. But for the time being, the dollar's become overbought in the short term, and we're seeing some profit taking. Now we'll come back and have a look at the 4 hour charts. And here we can see dollar yen has come back. Having reached this 114.70, it's come back. It's 113.5 now. And it has to be said, the 4 hour charts actually look a little bit heavy. So if we do go through this level on Monday, we can expect a 113.20, 113, and then the next FIBO level down at 112.60 or so to provide targets. To be honest, I think if we saw it down around those levels, I'd be looking for areas to buy it again. We'll move out to the dailies, and we can see that the daily indicators have become overbought and they're now turning lower. So I kind of think we've probably got a little bit more downside in the dollar yen in the next coming day or so. But as I said, in the longer term, structurally, I'll be looking to buy the crosses somewhere. I think the stock markets are probably heading higher, all things being equal. But and I think as that happens, and possibly yields start heading higher as well, that will underpin the dollar, and we should see dollar yen resume its uptrend. And the same currently applies to the crosses. There, you all became overbought. They've corrected lower, and in the short term, they look heavy. We'll go and have a look at some of those in a second. But longer term, I still like the idea of the yen crosses all moving higher. The Aussie, we'll have a quick look at the Aussie. And here we have an hourly chart of the Aussie, which had a pretty choppy session on Friday. Got up to 75.15 or so. Fell off quite heavily in the States, down to 74.5. Came back to meet this FIBO support. Closed at 74.65. But in the short term, it looks to me as though we could have a little bit of a bear flag on our hands. Possibly coming back down to test the 200-hour moving average on Monday. That's at 74.35. And if we get below, we could even head back towards 74, the figure. The hourly indicators, they are currently pointing lower. If we move further out to the 4 hour charts, the indicators look equally heavy here. So out of choice, I'll be looking to sell rallies towards 75 on Monday with a stop loss above Friday's high, 75.15. But in the longer term, I kind of think I like the Aussie. Although having said that, one of the Australian major banks came out and said they think the Aussie will be at 75, the figure, by the end of the year. They said that last week, and I think they're probably not too far from the truth. So I'd be looking probably to trade the range. You're looking to buy it around 74, below 74, the figure, and sell it above sort of 75, 77, towards 76 cents, I guess. And looking to play that range for the next couple of weeks. But in the meantime, the 4 hour charts do look heavy, so I think we might see a further downside pressure on Monday. Going ahead to the dailies, here we are. We can probably use this is the 200-day moving average here. That's at sort of 75.55. The 100-day now moving average 73.94, and they probably are providing the parameters, I think, for the week to look to trade that. So the daily charts do look relatively positive, I have to say, but possibly becoming very mildly overbought, and we might see a bit of a correction lower. I prefer to trade it from the long side because I do think eventually the Aussie, although it probably stays in a range, I think dollar yen probably does head higher as long as the stock markets and risk sentiment remains positive. So the Aussie crosses should stay underpinned, or Aussie yen should stay underpinned, I should say. So, and as far as the weeklies are concerned, The indicators here look very mildly positive, so that kind of adds to my view of preferring to play it from the long side and buying dips, but without looking for too much above 75.5, 76 on the top side over the next week or two. Okay, actually we'll have a look at the Kiwi, which looks pretty much the same. We've come back here to rest, or we're having reached our target. We were looking for 72.10, I think it was last week. Got up to 72.15, so that was quite a nice move higher, and it's now come back to sort of 71.35, 40. 45, and the FIBO support is here at 71.35. It looks as though we're going to break lower. I guess this spike here, 71, the figure that'll be minor support, but the major FIBO level is down at 70.80, and it wouldn't really surprise me to see it down there. But once again, looking to buy into weakness, I think, for the longer term. If we go out to the dailies, the momentum indicators on the daily charts do they look, the MACDs look positive. The RSIs and the stochastics might be a little bit toppish, so that kind of ties in, I think, with the view that we may be seeing a little bit more downside yet before we can look to buy. The 200-day moving average is down here at 70, just under 71 cents. So maybe look to buy it there, but I actually think we might head a little bit lower than that. So I'll be looking around sort of 70 3/4 myself to be looking to try and buy. The 100-day moving average down at 70.20, so I'll probably keep stops on new longs down there if and when we get lucky. We'll go and have a look at the crosses for a second, and I won't spend too long on the crosses, but the one I find particularly interesting is this weekly Kiwi Yen cross. Now that's, you can see the momentum does look to be building to head higher here. Now we've broken beyond the 61.8% of this whole move down, which commenced way back in sort of 2014, and we're currently not well. We've come off from the trend high, but we are sitting above the 61.8% level. And if we can take out that 82.5 level in Kiwi Yen, then we're probably heading towards this level here, these highs, which is sort of at 84, and then the next FIBO levels not till about 86. So that's a long way off at this point in time. I just need to blow that up a little bit. As you can see, we are trading above the 61.8% level. There's going to be resistance at these peaks here. That's what 81.60, and this one here, which is at 80. Well, that's not till 82.80, and then we get to these this triple top here, so just under 84. But I like the fact that the indicators do appear to be moving a bit higher. And I think it's just a trade worth following. If we come back nearer home to the short-term charts, and here we have a 4-hour chart of Kiwi, and I think there's probably going to be better levels to buy it. 80.5 looks to be able to come into play, 80.60, something like that. And then there's probably not an awful lot until we get back down towards the 80 level, possibly sub 80. But I'm doubtful we're going to get there. Having said that, if we look at the daily charts, we can see that the momentum indicators are overbought, and RSIs and stochastics are turning lower. So I wouldn't be looking to go long at these levels, but I do think we can see this kind of pull back, and then around that 80 level, maybe just below, if we see it, then I'm looking to go long again for the next leg higher. The same really applies to Aussie Yen. We'll just have a very quick look at that. So Aussie Yen made a new 3.5-year high last week, came back off its highs. But once again, the indicators not really showing us an awful lot actually, Aussie Yen, but if anything, they're looking very slightly positive. The 4-hour charts, though, once again seem to suggest that there's probably better levels than to be looking to buy it. The 84.25 seems to be the first port of call, and below there we've got these highs here. It's 83.80, and then down here at 83 the figure. I'm not sure we're likely to see that this week, but having said that, that's kind of where I'm looking to start putting on a long position, looking for the next leg higher. Okay, so that's about it as far as the currencies are concerned. I'm not going to go into all the yen crosses. They kind of look the same. Euro yen and sterling yen, I think, also a good play, but I prefer to concentrate on the Aussie and the Kiwi crosses, purely on the global growth outlook, which, although that might be slowing for the time being, I think there's a lot of pent-up demand, and that's why I think the Aussie and the Kiwi are going to really outperform further down the track. So let's move forward to the stock markets. And here we have a 4-hour chart of the S&P, and as you can see, very slightly just made a new all-time high on Friday before coming off, finishing slightly low. And it has to be said, the 4-hour charts look a bit heavy to go into Monday, so I'd be somewhat doubtful of taking that all-time high out again early in the week at least. We've got some major reports coming out this week, all the big tech boys reporting, Facebook, Alphabet, Microsoft, Apple, Amazon, that sort of crowd. So I think we're probably just going to continue to unwind until we see the numbers coming from those guys through the week. But having said that, although the 4-hour charts look a bit heavy, the dailies are suggesting to me that we still need to be buying the dips. So I'd be looking back for a move back as far as the S&P is concerned. If we saw a move back towards 4,500, I'd be looking to buy it there. 45.60 is now the new all-time high. I guess you keep a stop loss below 4,500 in case the corporate reporting results don't meet expectations, but I would imagine they will, particularly Amazon. I think that'll blow through all sorts of records. The weeklies, well, the weeklies, they've been overbought for months and months, but this sideways trading that we've had has allowed that to unwind to a certain extent. And even the weeklies might even be turning a little bit higher now. So I still prefer definitely to trade stocks from the long side. But like I say, as far as early in the week's concerned, just keep a stop loss. I'll probably have a stop loss now around the 44.80 level in case we do see a spike to the downside. But even so, I'd still be looking to buy dips. If we saw it back at 44.50, which I don't think we're going to, I'd still be looking to buy dips down there. I think because I think eventually we'll. Although we've got a bit of a double top here, I think eventually we're going to take that out as we move into year end. The same applies to the other US indices. I'm not really going to go into those. The Aussie markets, well, the Aussie market's lagging badly, mainly because of the Chinese growth story, I think. But even so, it closed up near recent highs. And if we can take out this sort of 74.5 level on Monday, there's not an awful lot to stop us going back up here to sort of 74.80 and even to the 76.4% FIBO level at just above 75. Not sure we've got the legs to make it early in the week. If the US indices really power on, the Aussie might get dragged along in the tailwind there. The 4-hour indicators are not showing us an awful lot. The dailies look vaguely positive, if anything. This 100-day moving average is down here. That's around sort of 73.70 now. So I'd be keeping stop losses on longs below there. And I think we probably can drag slowly higher, but I'd be quite surprised, I think, if we saw much above 7,500 in the coming week. But that remains to be seen. No, overall, I do remain positive, but I think it's going to be a slow process. Right, okay, we'll have a quick look at some of the commodities. Okay, here we have a weekly chart of oil, and that seems to be where the main interest lies. This is West Texas Intermediate, and we've come back and taken out, well, we've closed pretty much on our target to 83.65. It's currently at 83.95. It did trade above 84 on Friday, got up to 84.19 by the looks of it. Now, the indicators do point higher, the weeklies, and I think we're probably slowly but surely going to grind on to 90 and probably onto 100. This energy crisis seems to have no end at the moment. I think a lot depends on the meteorological conditions. It's been forecast that it's going to be a mild winter in the Northern Hemisphere. But if the weathermen have got it wrong, as they so often do, if it's a cold winter, oil prices are going to soar. So I'd rather trade that from the long side than the short side. If we come back home towards the 4-hour charts, and as you can see, we have made a new high and close up here. It should be said, though, that we've on the 4-hour charts, we have got some bearish divergence. So I'd be a little bit wary up here. I'd probably be taking some profit if I was long. The daily charts don't really suggest any imminent danger of turning lower, but they may be getting a little bit toppish. But I'd still be looking to buy dips now. And if we come back to the 4-hour charts with level, as far as early in the week's concerned, I guess you're looking to buy it around 82.5 if we saw a dip down there. Stop losses really, this is at 80 3/4, so I think stop losses need to be left below 80. If we go below there, we're probably going to test back down here, sort of 78.85. I don't really think we're going there. So I'd be looking to start buying. If you're not already long, probably start buying at sort of 82.5 or so. and averaging in down to 81, but with a stop loss, as I say, just below 80 for the time being. Longer term, I think we are going higher, but it's all a little bit choppy and uneven at the moment, so it lacks a little clarity. If we move forward to gold, which has even less clarity, gold had a pretty amazing day on Friday, having sort of started off at around 1785. It actually spiked up to 1815, came back all the way down to 1780 and closed at sort of 1790.95. So in the short term, I'm not really quite sure what to make of it. Basically, I think we are going to have another look at 1800 and above. I remain quite bullish on gold. The 4-hour charts, not really quite sure what to make of those. As I say, you can see that spike there, but we failed to maintain the levels. But I'm looking essentially eventually for a move back to 1830, which kind of ties in with this trend line here. And eventually I think we're going a lot higher, but it remains to be seen. I'm maintaining a small long position in gold, but it's been quite hard work all through this level here. But I kind of like it now. The daily, once again, they're telling us very little, so it looks to me choppy. But let me just blow this up. We are sitting right on this 100 and 200 day moving average, and it's quite feasible we could get another dip lower again if that resistance stays in play. But eventually I do think we're going higher, and I think 1835 will get taken out. We then head in, basically I'm looking for 1860. So that's the way I play it. Silver's had much the same kind of deal on Friday. So silver saw this spike up to sort of 24.85 before coming all the way back down here to sort of 24.20 and then finishing at 24.35. Once again, the hourly charts, well, they look a little bit heavy. I wouldn't get too tied up with those. The 4-hour charts, if anything, they look slightly heavy, but the trend, as you can see, we're making higher lows all the time. So I do like to buy dips in silver, but we may get a better level towards 24 to buy it. The daily charts, they do seem to be winding up for something bigger on the top side. This 100-day moving average here is at 24.5, and the 200-day moving average at 25.5, essentially. So that would be an immediate target. As you can see, the higher highs here, and the trend is higher. So I kind of like buying dips and trading that from the long side. Anyway, so we'll leave that there for now as far as the various products go. We'll have a quick look at the calendar. Okay, so here we have the calendar, and as you can see, Monday and Tuesday both look pretty empty. We've got the German IFO, and we've also got some regional Fed numbers coming out from Chicago and also from Dallas, but that's about it. We've got some US housing data out on Tuesday. As we head into Wednesday, we start with the Kiwi trade balance for September. Then we've got the Q3 Australian CPI. That's the Reserve Bank will report that, and it looks like the numbers are going to be pretty similar to the last month. So on that basis, you wouldn't expect too much of a surprise there. Later in the day on Wednesday, we've got the durable goods orders coming out from the States, and we've also got the Bank of Canada's interest rate decision. Probably unlikely to raise, although there is a small chance they could hike rates. So that remains to be seen, but the general theory is that rates will remain unchanged at 0.25%. As we move into Thursday, we've got the BOJ, and then we've got later on in the day, we've got the ECB interest rate decisions. No changes expected once again there, and all eyes will be on the statements and the press conference. We've got German CPI coming out. Then later in the day, we've got the preliminary Q3 US GDP number. So that'll be quite an interesting read, and it's expected to be a fair bit lower than the previous quarter. So that might create some volatility in the markets on Thursday. Then as we head in towards the end of the week, there's not an awful lot out. We've got the first up will be the Australian retail sales for September, and then we've got the German GDP and the EU GDP, to be followed from the US by the PCE index and the consumer sentiment and purchasing managers numbers. The other things we need to take note of are the corporate reports this week, and the major dates there. On the 25th, we've got Facebook. On the 26th, we've got Microsoft, Alphabet, Twitter, and Visa. The 27th, we've got Boeing, and then on the 28th, we've got the big one. We've got Apple and Amazon. We've also got Caterpillar, Merck, and Newmont. So it's going to be a pretty heavy week as far as data is concerned. Plenty of opportunities. Like I say, I think the stock indices eventually will head higher. The US dollar, I'm not really sure about. Keep an eye on the yen crosses, though. That looks far more interesting. And both gold and oil, I think, are probably a buy on dips. Anyway, we'll leave it there for now, folks. Have a good one, and we'll talk to you next week. Cheers.